Now, the next two are two really favorites that I'll talk about a little bit in more detail. And this is what the course will cover next weekend, next Saturday. So the first one is part of it is kind of the income calendar spread. So this is kind of where we start. And so the income calendar spread is, these are really cool structures. So it's a favorite medium to longer term non-directional strategy, option strategy. And what the spread is basically kind of a neutral option strategy that profits when your underlying stock or security remains stagnant or trades within a tight range, kind of like a credit spread. So its profit's going to primarily comes from the rate of your premium decay and the implied volatility decay between the near-term short option and the long-term option. So it's going to be possible because remember, think about options. When your near-term option premium is always going to be decay faster. So it's getting closer to expiration. Expiration, it goes to zero. So it's going to be closer to that expiration date than the long option that you're long. It's going to have a longer duration. So it's not going to decay as fast. So you're just playing the spread between the two duration periods. So it's an excellent strategy if you expect a stock or security to stay stagnant, like a credit spread or iron condor, within a tight range. So you can produce income from that time decay. So the way that I like to use these are kind of what we call it a target trade or range-bound trade. So really great to use when you have conditions where you want to, say, keep a longer-term position intact for a stock or even an ETF, but you're expecting it to potentially break out to the upside or downside in the future. So you can set this up really cheap in the short term, collect a little income, and then still be positioned for a break, further, in the future, either up or down based on, your strategy direction. So it allows your position to get paid while you're waiting for that long-term breakout. So basically, you're playing just in theory, you're playing the spread difference, your duration difference. So you can do this with weeklies, but this example is like on a monthly. So let's say you went out 60 days and you bought a $100 call option here, and maybe that cost you, we'll go through an example, maybe that cost you $50 or something like that. But then you sold closer in 30 days in a $100 call. Okay, so you're short here, long here. So you're the same strike price. So all you're playing is the differential between your decay. So it's a timing spread, sometimes called a horizontal spread. So that's all you're doing. You're playing that decay. And then if we have a target, we can target to a certain point like a butterfly, and it kind of acts like a butterfly. Then you get that full amount in your pocket. So that's kind of the concept how it theoretically works. But the reason we start, I like to show you the call, our calendar, we can do calls or puts, is because then the next thing progression off of is the counter diagonal, which is really a great strategy that you must, to me, it's a must-have strategy for your option trading. So here's the calendar, okay? So here's kind of example of how it works in theory. So let's say you went out and you're long a March 38 call and then short the Feb 38, okay? So you're just playing the duration, the time between the two durations, okay? So it's going to be open for a debit, benefits from time passing, so time decay, also going to benefit from implied volatility crush. Those two components go zero at expiration, right? So it's a defined risk trade. The debit pays your total risk, takes advantage of accelerated time decay from the option different time frames at different rates. And so let's say an option contract with 4 weeks remaining will decay in value at a much greater, faster rate than the contract with 8 weeks. So that's what you're playing, the duration period between the two. Okay, and if it just sits, so if it sits stagnant, going nowhere, you get that differential of that theta that goes straight to your pocket and stays like a credit spread. So we can build off this strategy. We can build it into calendar diagonals, and it's what I call a flexibility trade as well. So then here you can see your long March 38 call cost you $400 debit costs, and you shorted that 38 February. You brought in $100. So your spread going into the trade was $300. The trade sideways, let's say in this example, so then you're closer to that Feb 30, that Feb expiration, the 38 call then is really going down in value. The 38 call is not really doing anything. So you can see your 38 call cost you $400 out there in March. Now the 38 FIP call though is decayed in value, and let's say it's cut in half, $50. So then you see your spread now has gone down to 350. It's 350 from 300, went from 300 to 350. So you just pocketed $50. It's like a credit spread, 17% return. So that's your kind of theoretical the theory behind it, the foundation behind the calendar, how it works.